Mere video.
Good evening, Miss. Today I'll be introducing my classmates first. My name is Joshua.
And I'm Durga Devi.
I'm Desal.
I'm Shamini.
Okay,
Next
next,
page.
please. Explain in general the net present value techniques eliminated in a general business operation. Capital investments appraisal techniques are set to tools the business use to evaluate the potential profitability and feasibility of long-term investment projects. These techniques help decision makers determine whether to invest in assets like new machinery, buildings, or expansion projects. Net present value. The method discounts of all future cash flows of a project bank to their present value using a predetermined discount rate, reflecting the cost of capital or required rate of return. The initial investment is then subtracted from this total present value. Uh, When a business considers a capital investment using a net present value technique, the process generally involves the following steps: identifying potential investment projects, estimate future cash flows, determine and discount rate, calculate the present value of cash flows, calculate the net present value, make the investment decision. Next.
Challenges in capital investment appraisal techniques, uncertainty and risk in future cash flows. When businesses predict future cash inflows from a project, they are making assumptions based on current information. However, market conditions like demand, competition, cost can change, making those cash flow predictions go wrong, leading to wrong investment decisions. Difficulty in estimating the cost of capital. How capital investment appraisal often uses a discount rate like WACC, weighted average cost of capital, to bring future cash flows into today's value. Next. Oh. Over reliance on quantitative data, most appraisal techniques like net present value, NPV, or internal rate of return IRR focus heavily on numbers, profits, costs, returns. They might ignore important non-financial factors like customer satisfaction, employee well-being, or brand reputation, which can impact long-term business success. Time and resource intensive. Proper investment appraisal requires collecting detailed financial data, market research, and scenario analysis. This can be time consuming and expensive, delaying quick decisions, especially when businesses need to act fast in a competitive market.
For the capital investment appraisal techniques plays a critical role in supporting businesses to make informed strategy regarding their investment. The following are four specific benefits of implementing these techniques. First, better decision making, which is capital investment techniques such as net present value, internal rate of return, and payback period. These are providing businesses with objective data driven insight. By evaluating the potential profitable and risk of different project, businesses are able to select investment that be best aligns with their financial goals and long-term strategy. Second, efficient resources allocation. Resources such as capital, time, and labor are often limited. Capital investment helps ensure that these value resources are allocated to projects that promise the highest returns and strategy advantage. Third, risk management. Every investment carries a degree of risk. Through detailed analysis and forecasting, techniques identify potential financial, operational, and market risk with different investment opportunity. Recognizing these risks early enable businesses to implement approaches strategy, reduce the chances of project failure, and protect the organizational financial health. Class performance monitoring. After investment are made, businesses can use capital investment, which is to compare actual project outcomes against initial projects. This ongoing monitoring promotes accountability, helps detect division early, and provides value lesson for future investment decision. Thank you.
So, as a conclusion, the net present value appraisal method is an extremely useful tool to analyze a company's capital expenditure. It's also a transparent and trusted framework for decision making, in addition to taking the time to value of money into account. Its disadvantages, such as focusing on value creation and accounting for all cash flow, make it a popular approach in strategic financial planning, with its disadvantage, which include forecasting and selecting the right rate of discount. So the businesses can increase shareholders' value and support long-term growth by using net present value to make more informed investment decisions. So that's all from us. Thank you.